Hi everyone, you're all very welcome to our weekend markets video here, just to round up the price action for the week that's just gone by. First kind of real proper week in earnest for the new year, obviously factoring in the volatility from the previous week or the previous shortened week, obviously with bank holidays and so on. So third week of January now, kind of in earnest, over. Real volatility now starting to creep back in. So we talked about it this week about the volatility kind of coming back into the markets, looking for a return in terms of the intraday movements back and forth. We've obviously been talking about the back end of 2022 as well. Now, this week's weekend markets call, we're obviously going to be looking at the different performance in the different asset classes, dollar, FX pairs, gold, and of course the indices as well. However, before we look and start to kind of review the price action of the week, there are a couple important elements to take into consideration for next week's trading week. So, of course, within our dashboard, we do obviously have the economic calendar, which is very, very, very important. But, of course, we do have other articles, other information. So, of course, next week is really, we talked about this week in terms of earnings season, but we're going to start to see a lot more of these major prominent companies reporting earnings next week. Now, next week, we've got Tesla, Microsoft, the bigger ones like Amazon, Apple. They're going to be coming through at the beginning of February. Now, the first thing that I would be saying is, if you're trading stock market indices, if you're trading the buys and the lows, the buying and the selling price action, should I say, of the indices, it is important to be uniquely aware of the elements that can affect the market movements of those assets. So anything that's going to affect the movement of a particular asset that you're trading, you really should be up to date with it. You really should be kind of aware of it. So at least that way, then you're not getting caught offside in terms of price action, bluntly speaking. Okay. Now, over the next couple of weeks, as I said, we're going to get a raft of earnings, whether it's tech related stocks, whether it's the financials, which we've had some obviously this week, whether it's the likes of your utilities play, your energy stocks, whatever it is, right? We're going to have all of these companies reporting earnings over the next kind of 3 weeks or so. And it's important to uniquely know what are the main companies that's going to affect the performance of those related indices. Because naturally enough, at the end of the day, right, if you look at the S&P, if you look at the Nasdaq or the Dow Jones or any other index, all of these indexes are composition of a group of number of individual stocks. And it's important to understand what stocks are in what index, but also the weighting and importance those stocks have in those respective indices. Okay, so naturally enough, if we look at this website here, which is called Slick Charts, it will give you the composition weighting of each individual stock within the retrospective index that you're trading. So, for example, here, looking at the Nasdaq, we can see that the Microsoft and Apple component weight is almost 12% in each instance of the Nasdaq. So naturally enough, over the next couple of weeks, the Microsoft earnings, the Apple earnings are going to be very, very important, because that's going to lead to intraday movements in the likes of the Nasdaq. And that's really, really, really important, particularly if you're looking at those indices solely or more broadly within a composition of other assets as well. Okay. This website will break it down. So you've got the Nasdaq, you've got the S&P, you've got the Dow Jones. It'll break them down individually. So if you're looking at maybe the three primary indices in the US, you'll probably see that there's 5 or 6 centralized stocks which has the most weighting. So naturally enough, your Apple, your Amazon, your Microsoft, your Google, maybe a couple of your financials, like obviously Morgan Stanley and Goldman Sachs and your Dow Jones. So they're going to have relative importance rather than maybe 75-80% of the other stocks, the other primary stocks in the stock market. So at least that way now you know the composition weighting. So Slick Charts is a very, very useful website. Also, Earnings Whisper will tell you the calendar. So, for example, if you go to the 2nd of February, which I know from beforehand, and we go after market close, what are the companies that's reporting earnings on the 2nd? Well, if we go AMC for a second, we've got Google, Amazon, and Apple. Okay, so those 3 stocks specifically on the same date are going to affect markets. So naturally enough, you're going to see probably some sort of response between kind of 8, 9 o'clock in the evening, 10 o'clock in the evening, at night, when these earnings or when these stocks report earnings. Now, it just so happens on the 2nd of February, we also have Bank of England, we also have ECB within the central bank. So naturally enough, the 2nd of February is going to be a very, very important day for the markets, broadly speaking. So being aware of these things allows trader to gauge how they approach the markets. Okay, so if you're a technical trader only and you don't trade news elements, well, it's important to know when these major events are coming out. So at least that way you can try and avoid them. You're minimizing the risk. You're not potentially taking a trade, not knowing what's coming out, and then getting caught out maybe with slippage or whatever that potentially happens within the markets. So it's all about having a clear plan, a clear structure, but also having focus and orientation into what you're looking for. And that's really, 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 really important. And that's what separates a lot of the successful, profitable traders from those who show moderate degrees of profitability and moderate degrees of consistency. All right. So Earnings Whisper is a very, very good website. Slick Charts, as I said, is the secondary website for the components weightings. We've uploaded all of this information into the Discord as well. We've made it freely available, all of these different useful links in different websites as well. So obviously try and tap into that. I think it will help understanding the broader markets and obviously avoiding these times of volatility. Now, the last website is FinViz, and that just looks at the intraday weekly performance of the market. So naturally enough, if we look at the US markets last week, broadly speaking, the markets were down with the exceptions of maybe a half a dozen stocks. Apple had a good week, Google had a good week, Amazon had a good week, Tesla over here in the top right also had a good week. Some of the energy stocks had a good week, but a lot of the vast majority, as you can see, probably 60-70% of the stocks have been down for the week. So that's obviously going to retrospectively factor back in to the performance in the markets as well. All right. So as we head to obviously the price action this week, what have we seen in the markets broadly speaking? Well, if we look at, I suppose the best place is probably to start is with the dollar, right? That dollar demise is still continuing to play out from obviously the NFP at the beginning of the month, the CPI from last Thursday week, and we're still seeing that dollar fade. We're still seeing that dollar weaken, which again is giving a little bit more optimism in the likes of the gold prices. It's giving a little bit of optimism in terms of the euro, in terms of the pound, and we're seeing a lot of those FX plays still continue to play out. That kind of narrative that we've talked about over the last probably kind of 8 weeks, 10 weeks, 12 weeks is still playing out, because of course when you look at it from an intraday perspective, this broader trend is still very, very much intact. We're seeing that continued dollar weakness. As I said, NFP last week from the CPI, that sustained sell-off through the course of the afternoon. Now last week is where things started to get a little bit choppy. Why? Because we kind of moves back and forth out of a broader range. But when you look at, let's say, the 1 hour charts, you look at the lower time frames, you can see that intraday volatility, right? Last week, for example, on the Dax on Wednesday, we took the highs, we very, very quickly took the lows, came back into the region, rejected this area of liquidity here between kind of 102.40, 102.60, and actually sold off into the close again into these local lows that we've kind of seen from Thursday and Friday. So really the goal now is to see, right, now that the DXY is closed just marginally below 102, are we going to see that filtration of dollar weakness continue to play out? If we see that, right, well, then we should be looking at Euro USD probably trend to continue moving higher, cable to continue moving higher, Aussie, Kiwi, some of those pairs to obviously move higher, and anything where US dollar is the base in the FX pair, we're obviously looking for those to be weaker. So for the last examples, potentially US dollar yen, US dollar Swiss are two prominent examples as well, particularly if that safety element of out of dollar strength into obviously dollar weakness as well. All right, so that's obviously the first thing. And I suppose with that, then we're kind of looking at the retrospective price action within the euro, Euro USD, GBP USD, etc. And we're seeing that Euro USD strength still very much continue to play out. Now, again, we talked about it last week, that NFP strength, the CPI strength, markets last week very much ebbing and flowing back and forth between kind of 108 and 109, broadly speaking. And again, that's fairly natural or fairly normal in the markets when we see trends going from, let's say, a region here of 96 all the way up to 108. That's a 1,200 point move. So naturally enough, markets won't always be moving in the same direction consistently. That's how trends work. That's how price action works, broadly speaking. Price action is the evolution of markets, and it's the continuous constant battle between the buying order flow and the selling order flow in the markets. If there's more buying order flow, obviously the trend is going to go higher. If we see that evaporation in buying orders, then you're going to start to see the accumulation, kind of like what we're seeing here at the minute, a bit of a pause, a bit of respite. And I suppose that's really, really kind of what's important as well, knowing when to trade, knowing what way the market dynamics are playing out or focusing on. And then if we do get that change in sentiment, you're uniquely able to identify that. You're uniquely able to factor that into your own analysis. So therefore, you're obviously not potentially getting caught out. So let's say you're buying when you really should be selling, and vice versa. All right. So Euro USD, as I said, this week is very much back and forth between kind of 108 and 109. But more broadly, we're waiting to see how does that DXY play out. If we see that continued break of 102 to the downside, you're going to see Euro USD kind of gradually climb higher. And I think that 109 level, although we haven't hit it yet, from obviously Wednesday's highs at 108.90, 108.85, it could be a very, very potential play. So obviously just kind of wearing that in or pricing that into consideration as well. All right. So that's the first thing. I suppose cable now, as we look at cable secondary to that, I'm just kind of looking at some positions I had myself last week. Of course, cable rallied from an order block liquidity perspective. Very, very nice play on the cable. So I'm just going to remove this temporarily. Very, very clear bullish order flow back into the liquidity area, consolidated, and even on the shorter time frames, you'll see it there as well. Taking of lows, taking of highs back into the region. And of course, from that, we very, very quickly continue to progress to the upside back into this daily liquidity area here between kind of 124, 124.20. And of course, when you look at the higher time frames, we did come into these local highs from the middle of December, just above or just underneath 124.50. Markets obviously rejected on Wednesday, should I say. Thursday got a steady grind higher. Friday closed the week stronger. So we're really looking to see what the next phase of dynamic is in the DXY, because retrospectively that's going to price in. And of course, if that DXY continues to move lower, really and truly, the likelihood is that cable, this kind of short-term pullback that we saw into year end, would probably continue with the markets progressing higher and looking for that kind of move higher into kind of 125, 125.50, all the way up into this daily order block. Now, of course, when you look at the logical scenario of price action, we know what goes down must come back up eventually. That's how price action works. That's how the markets work. They're generally liquid in the sense that trends will move for a certain period of time. But once the selling cycle is done, you'll tend to get evaporations, you'll tend to get crossovers, and you'll tend to see those markets move higher. Now, I suppose at this point in time, this area here between kind of 125 above the kind of the short-term highs of mid-December is really what's important. Does the markets break above this level on the higher time frame? Because of course, if we see a closure above 126, then you're really looking at that higher time frame V-shaped reversal, whereby markets has been very, very consolidationary, very, very clear downside break of structure, taking out lows from 2020 and of course from 2016 and 2019. And the natural bias is that markets will return. It's kind of like what we're seeing in gold as well, playing out, but obviously on a shorter time frame parameter. So wouldn't be conceivably impossible to see cable by March or April going 132, 135. And in fact, they're more probable scenarios. If we see the price action taking out kind of 126, that's really kind of what I would be looking at, personally speaking, from a longer term perspective, is seeing cable return back up into 130s, back up into kind of mid 30s, maybe 135. And that's, again, not too distant from the time where we had in October, where market sentiment was, particularly from a fundamental institutional aspect, was analysts were saying, well, cable's going to go to parity. It's going to go to parity. And then, of course, we had that V-shaped bottom. And that's solely focused on the price action, I think, is what's most important. And being able to articulate that back in and saying, well, if there's more buyers and sellers, we're going to naturally get that change in trend. And that's really, really what's important here. All right. So cable obviously continued to progress higher. If you look at the weeklies, strong weekly closure obviously this week. It does look like market dynamic is going to have a run at 125, 126 next week. I think is going to be important, because if we do see that dollar weakness, particularly into the Fed, obviously 1st of February, we have the Fed meeting. We've also a raft of US data on the 1st of February. So naturally enough, that could be a potential new high into obviously the FOMC, potential pullback on a fundamental shift potentially, and then you're getting your highs and lows within a trend. And then it's a case of, well, look at the broader perspective, look at the broader price action. What is the price action telling us? And disregard a lot of those short-term, I suppose, ebbing and flowing between commentary. And I think price action over commentary is definitely the way to go. Now, USD yen, right? What are we seeing in USD yen? Well, again, evaporating price action for a second. Again, we're seeing this broader trend continue to play out. And of course, what goes up, as we said, must come down eventually. Very, very clear bearish order flow. Liquidity areas the whole way down, right? Continued breaks of structure, continued, as I suppose, bearish trend, very, very clearly being articulated and illustrated. Lows, highs, lows, highs, lows, highs, back up into the liquidity levels in a lot of circumstances, like, for example, here, and like, for example, here, only for the price action to roll over again. Now, this week was incredibly volatile because, of course, we had BOJ on Tuesday night into Wednesday morning. We had that brief flash in the pan influx of price action, but of course that is the algos. Price action very, very quickly rallied all the way up to this kind of 130, 150 level and almost immediately back down by mid-morning, right? And again, that demonstrates the algorithms, the importance of focusing on the liquidity, focusing on the price action rather than getting drawn into the short-term narratives of fundamentals in the markets. Yes, fundamentals are important if you're trading news, if you're trading short-term impulses, because you're catching the markets at the right time. But if you're not doing that, take a step back, look at your order blocks, look at your liquidity areas, because that'll hold more relevance, particularly on the intradays, the 1 hours, the 4 hours, and even the daily charts as well. All right. So daily highs have coming through here at 130.60 on dollar yen, continued low. So you can even see here we're refusing to take out this low from Tuesday night, Wednesday morning. Markets is evaporating back down again. And if you look at a 1 hour chart, you can see that playing pretty clearly. Okay, markets very, very clear and tangible move back down into the range, rejecting area, and then of course getting that secondary move early Friday morning, and of course selling off into the close as well, off the back of that DXY weakness. So I think DXY is going to be really relevant for the next few weeks. I think really up until probably mid-March, early April, I think is really when the DXY is going to be of most relevance and most importance, because of course we know, right, in 2021 and 2022, yes, all central banks lagged in terms of the policy, but in 2022, the Fed was the first one to act and did so very, very aggressively. Now, all of the other central banks are playing catch up as we speak. For example, Bank of England, for example, ECB, whereas the Fed is very, very further along in terms of where it wants its interest rates policy. And we know at this minute in time, federal interest rates, federal fund interest rates are kind of around about 5%, or looking at really kind of 5.2% by really March, indicates you're probably going to get 25 in February, 25 in March as the most likely scenario. And that's kind of something that I've been kind of talking about in terms of commentary really since November, December. 50 in December, 25 in February, 25 in March, and then obviously a pause. And that'll obviously give other central banks the time to increase their interest rates. Bank of England maybe going above 4.5%, ECB probably going above 3.5%. And all that means is, right, that cycle of dollar strength that we saw through 2022 will evaporate. Why? Because the dollar is now, or the Fed is now maintaining a more neutral policy, whereas obviously the Bank of England, the ECB are probably still going to be fairly aggressive in its approach. And if that plays out, then you're really looking at euros, Euro USD, GBP USD really continue to move higher. Probably Euro USD back into the teens, probably between kind of 112, 115 would be a likely scenario. And cable really getting back into those mid-high 130s. I think that would be probably the ideal scenario if we saw that actually play out. Now, of course, we've a February meeting in the Fed. We've got the second. We're going to have ECB and BOE. So that's obviously going to be important in that regard as well. All right. So that is obviously dollar yen. If we move across to the Aussie, what are we seeing in the Aussie? Well, we're just going to move this for a second, go to a higher time frame approach. The Aussie price action is still continue to tick higher. And of course, with the higher movements in gold, that is definitely helping the Aussie and the Kiwi in recent weeks, because of course what's happened really since November, massive influx in gold strength. Of course, that weaker dollar plays we saw through 2022, that weaker cycle of price action, continued lows and highs from really mid-March, early April, filtered through into the back end of the autumn, where we had those lows around 1600, 1625, and we've seen that cyclical reversion and trend all the way back up into these 90s. And I'm kind of saying it now for a few weeks. 1950s, 1975s is the likely scenario, really, to undo this weekly cycle of price action, and we're really looking to see, can the price action get all the way back up? And at this moment in time, it's getting there. Now, it's been very, very aggressive through January. You'll see it the first kind of 2-3 weeks of January, very, very aggressive movements in gold, but we're also seeing that in the Aussie. Okay, the Aussie has continued to grind higher. The last, let's say, couple of weeks or so, we've gone from 67s all the way up to 70s, where we've initially rejected. But when you look at the broader trend in the Aussie, and obviously the Kiwi as well, again, very, very clear cyclical decline through 2022. V-shaped reversal, getting that break of structure, break of trend, and the markets is now climatizing to more averaged out levels. So yes, 70 is obviously a short-term area, particularly into, let's say, the Fed meeting at the beginning of February. But really and truly, if we see that dollar weakness continue to play out, if we break back under 101s, back under the June lows on the DXY, if we show you that as well, let's go to the higher time frame. that's really then bringing in kind of 97s, 98s. And of course, if we're seeing 97s, 98s, that really means that gold should move higher. Aussie really should move higher. And we're really then kind of looking at a full undoing of this 2022 cycle from, again, when we sold off late March, early August, or sorry, late March, early April, should I say, between kind of 73 and 75. And those are very, very realistic expectations if these current trends continue to play out. And of course, the order flow is still very, very much bullish in all of these markets at the minute. Like, for example, Euro, Cable, like, for example, obviously Aussie here as well. So it's important to play out the trend in retrospect to how it's actually playing out. So of course, if the Aussie is playing out the fundamentals of bullish, then you're really kind of one-dimensional in your approach. It's only when we get a break of structure, break of trend. Yeah, from a shorter term perspective, that's ideal. But from a longer term perspective, it's given us a more overriding focus of the broader markets. And of course, as we look at this moment in time, bring in the order flow, bring in the liquidity. Of course, we're seeing breaks of structure. For example, the most recent ones here, very, very clear assimilation to the upside. Yes, we have a liquidity order block level down here around 67, 67.50. Very, very clear reaction from here, because of course that is the initial insights of where this impulse took place from. And we've had that gradual accrual of strength from 67.50 all the way up to 70.50. Now, as you'll see here, higher highs, higher lows, higher highs, higher lows. Yes, we have had an internal break of structure, but really now you can even see here that we've had equal lows. So does that mean that the price action is going to come back up here and reject 70, 20, 70, 40 this week? Well, that would be the short-term expectation. 70, 20, 70, 40 is the short-term expectation. And then really seeing, do we get a new high, or do we get like equal highs, rejection, taking of liquidity, whatever, and then evaluating the price action. I think from a short-term perspective, if you're higher time frame perspective, I would be saying probably still at this moment in time, DXY strength isn't really there yet. However, from a short-term perspective, this could be seen as internal break of structure, price action taking liquidity of this low and potentially this low back into this order block liquidity area, coming back up for one final run. But of course, if we're not making new highs above, let's say, 75, 50, 70, 70, 60, then the likelihood is this is going to be a short-term top, and we're probably going to get an evolution back into this 67.50 level from a short to medium-term perspective. So it's important to reconcile. What is your strategy? What are you looking for? What are your confirmations? Whether it's short, medium, or longer term. I mean, have clear focus within that as well. So we've talked about gold as well. Gold has obviously continued to assimilate upside price action. So very, very clear movements as well. Now, as we look at the markets broadly speaking, what are we seeing in the US now? I suppose, firstly, what I'm kind of seeing, particularly this week, if we go to the daily chart for a second, and let's just zone out for a moment, what are we seeing? Obviously, this was the most recent set of highs from September. Very, very clear move into the October CPI. Very, very clear market manipulation. If you look at a 4-hour chart, you'll see it very, very clearly. Manipulation, very, very clear taking of liquidity to the downside. 2-month bullish trend up into this consolidation level where we took this 4-hour order block over here above 4,100. Then obviously the December CPI was the catalyst for the taking of the highs, and we saw that decline. ECB, Fed, BOE, etc. all happened in here, but that was the narrative to break the structure, to break that trend. And of course, into Christmas, then we had the consolidation. Now, of course, early January, markets initial rump of the NFP, obviously taking the short-term highs, continued bullish trend for the next kind of 2 weeks continued to play out. And we saw that across the board, Dow Jones, Nasdaq, European indices as well, all the way back up into these liquidity levels. Now, again, last week, there was a big options expiry around 4,000. There was liquidity areas here around 4,000, very, very clear rejection. And of course, what happened on Wednesday? Very, very clear decline all the way back into this short-term low here. So for this short-term low from the week before, the Tuesday the 10th, where we had this initial break, price action returned all the way back down, held above this level, and we've actually seen some decent buying into obviously Friday's close. And of course, price action now is trying to make itself or navigate itself back up into this liquidity level. So from a short-term perspective, given that we've pretty much taken the liquidity from the December break, the secondary focus is, well, if the price action's coming back up, how does the market sentiment react in this region? And again, that is going to be between kind of 39.85 into, I suppose, 40.10, 40.10 region. I think that's going to be really, really important this week, because of course, if we see this continue to rise and we take out this liquidity level, then you're really seeing indices trend is probably going to continue to play out. Dollar weakness is still going to continue to play out. Therefore, we're buying Euro USD, we're buying GBP USD, we're buying probably gold in that continued trend. We're looking for dollar weakness, and risk sentiment is still very much heightened into the markets, into the expectations, probably another narrative of the Fed pulling back in its policy come February 1st. I think what you're going to start to see is narratives being proposed to fit the price action that's developing in the markets. And that's generally what happens from a broader perspective as well. All right. So that brings us to the S&Ps. Nasdaq again, very, very similar move. So Nasdaq was had a very, very clear bullish trend, obviously last week into really Wednesday, where we had that kind of break. Now we've had a very, very steep decline because, of course, even if you're looking at 1 hour charts for a second, let me just remove some of these shorter term focal points. We've had price action, obviously bullish trend, higher highs, higher lows. That was into obviously NFP. This was the CPI move. And of course, we had that move obviously into last week where the price actions come back from. Now, price action is making its way back up into this local area here from where we sold off from on Wednesday. Now, of course, really this is going to be the key architect to see how does the markets react in this region. Do we break through this region here between 11,620, 11,650 and continue progressing higher? If we do, then really this higher time frame area of liquidity here on the 4 hour or even potentially on the daily up here between 11,800, 850 becomes probably the next focal point, because of course this is bullish order flow, short-term break, creating obviously a more sustainable higher low within this impulse, and then obviously looking to continue moving higher. So as I said there, really 600 to 650 is going to be important on Monday. If we're getting a closure above that, then you're probably going to see sentiment coming for this liquidity area up here. I think that's really what's important. If you look at the broader markets on the higher time frame, Nasdaq has had a very, very clear decline through 2022. But of course, the weaker dollar play would potentially allow for potentially bullish indices. Nasdaq, right? We're seeing the moves already this week in the crypto markets. We're starting to see the leveling out in the yields, which we'll look at now in a second. We're starting to see the leveling out in the stock market bottoms, because of course, if the markets were going to continue moving lower, really and truly, in the last couple of weeks, late December, early January, would have seen a new market low. And of course, Nasdaq has held bottoms at 10.7 or 10.6. S&P's very, very similar move, because of course, if you go back to October, we've actually not even got back to those bottoms from where we were in October. So Nasdaq broadly was weaker, however, still holding those bottoms. And of course, if you look at the Dow Jones, what has happened on the Dow Jones, very, very similar move. Of course, see bottoms in October, clear run up, very, very short-term decline. And Dow Jones, broadly speaking, is holding a lot of its decline. Now, there's a lot of liquidity up here between 34.4 and I suppose 35,000. A lot of volatility, a lot of liquidity up around in these areas up here. And that's really, really going to be an important element for the next few weeks, because, of course, in the Dow Jones, you'll even see it there, higher highs into, obviously, daily order block rejection under 875s, which we actually talked about in previous weeks, into this consolidation level, back up into this liquidity area here, as I said, between 34,000 or 34,200 into, I suppose, these 34.4s, which of course is local highs. And of course, we've seen that fairly clear run off last week, as we said, all the way back to the NFP level. Now, of course, why was the Dow Jones so weak last week in comparison to the Nasdaq, comparison to the S&Ps? Because of course, it was the only one of the three indices that got back to the NFP level. Now, the reason why that is the case is because what happened on Tuesday? Morgan Stanley, Goldman Sachs earnings reports come out, broadly weaker. So Dow Jones was the only one of the three indices on Tuesday that it was actually weaker, right? Then, of course, on Wednesday, as the broader market sold off, naturally enough, the Dow Jones was going to be broadly lower than the other two in the week, because it had already a significant sell-off from the day before. And of course, what have we done? We found a very, very clear bottom. And again, where have we found a very, very clear bottom from? The NFP figure. Of course, accumulated price actions tried to take out the lows through the NFP, and of course, very, very strong reaction. So here now, personally, into this week, if you look at the Dow Jones at this region, we've seen break a structure from the accumulation zone. So we've tried to break to the downside, almost a V-shaped reversal. Really now, I would be looking to see if there's any more kind of one last move lower to take out this short-term liquidity area, and then look to see is there a bullish trend playing out all the way back up into these levels. So 33.9, 34,000 becomes interesting. And I suppose, broadly speaking, if you're looking even at the 4 hour charts, you've got 34,200 to 34,400. So you've got short-term area here on the 1 hour charts. You've got a broader region up here. And that, of course, would then mean that, right, if the dollar weakness continues to play out, it would be very much a potential scenario to just to keep an eye on. No trading advice here, but just purely observations from market dynamics and market sentiment. All right. Now, European indices. What's actually happening here at European indices? Well, European indices for the first day on Thursday, Wednesday had a bit of selling. Now, of course, what have we seen on the DAX? The DAX, we talked about this 15,000 handle. Very, very clear rejection up here around 15.2s, 15.250s on Wednesday, Thursday, all the way back to 15,000. And of course, we did find a little bit of bottom on Thursday into Friday morning. And of course, Friday afternoon, we have seen that correction. So DAX is actually pulling back into this 15,200 level again, and is very, very similar to the Nasdaq. So this Nasdaq here, as we said, short term 1 hour, 4 hour price action between 11.6, 11.650, break of structure, short term, very, very clear. Price action rallying all the way back up into this region. So that's obviously going to be important this week from a Nasdaq perspective. If you bring in the DAX, very, very similar scenario, of course, as well. From a price action structure, break of structure to the downside, forming lows around 15,000, getting that correction back up. So this region here is going to be important. So I do think we're going to rally from 15,000. I do think there is a little bit more emphasis in here on this one, but I would be kind of waiting and watching to see if there's any sort of reaction here, because of course this could be highs into lows for a new potential high as well. Because when you look at the broader trend, what are we seeing? Very, very clear bottom formation, aggressive bottom into consolidation into year end. And really, since the beginning of the year, the DAX has been on a massive rampage back into 15,000. So just be kind of wary of that. Now, as I said, 15,200 I think is going to be an important area to see whether this actually forms a potential lower high for a revision and trend to correct or kind of take out some of this order flow that we've seen over the last 3 weeks or so, or whether it's just merely a short-term low for the markets to continue pushing higher. And if we take out these highs here at 15,200, 250, really then the next level is up here at 15,700. And when you look at the higher time frames, you can see it out there pretty clearly. Okay, this is where we had our correction. Then of course 2022 we had that massive decline, obviously Russia invading Ukraine, and the effect that had on the broader European markets, whether it's commodities or obviously whether it's the stock markets broadly. Same again in the Euro Stoxx. Euro Stoxx, very, very clear top formed around 4,200. We even talked about that this week. Around 4,200 was an important level. Accumulated, obviously got that change of character. Short-term break of structure back into 4100s. However, the market dynamic is pulling back into this level again. So 4175, 4180 I think is important this week. And of course, if we're getting a close above this 4200 level, the likelihood is, again, DAX would do the likewise there, as we talked about, and you're really looking at market dynamic above kind of 4200, and that brings in kind of take your pick really. You've got 4250, you've got liquidity over here around 4300, and then you're back to all-time highs at 44. So we're not that massively away when you consider the decline that we saw through 2022 and the aggressive moves we saw October, November into mid-December, and of course the secondary wave at the beginning of this year. European indices are not that terribly far away from all-time highs, and that is all true, very, very clear, very, very obvious in the FTSE, which of course, when you look at the broader perspective, what have we seen through 2022? Well, if we go to the daily chart for a moment, market dynamic had finally broken out of this range. So this is where the FTSE was all year. 6,800, 6,900 was the lows, 6,600, 6,700 was broadly the highs, and then of course October, November, massive run up, and then from the beginning of this year another further massive run up. And that's really, really important, because of course what happened last week, well, of course we had evaporation and bullish order flow, structured short-term highs, very, very clear sell-off back to 77.50, but we are seeing a little bit of a short-term rally back into 7800s. Now again, I suppose the focal point, like with DAX, like with the Euro Stoxx, is seeing how does the markets react, not just at this area here, but also at this weekly level at 78.50. We'll talk about that in a second. Short-term, really this 78.50, 78.60. See, is there a lower high for there? If we come back up here, take this liquidity, reject this level, that's really top, short to medium-term top, short-term retracement, taking liquidity, taking the order flow, and really potentially seeing those declines back into 670, 650, 7700. Now, when you look at the weekly chart, why are we talking about this weekly level at 78.15? Because, of course, that was the weekly highs, roughly speaking, depending on the exchange you're using, the broker you're using, and the chart you're using on TradingView, 78.15, 78.20. So this region here was obviously really very, very relevant, because, of course, last week, the week before last, we got a very, very clear break above it. Last week, we got a closure back underneath. So this next week is going to be important to see not only how does the short-term price action reflect this week, but also how does the weekly closure come this Friday. I think that's going to be quite interesting as well. Now, that's pretty much all from the market updates. The last thing I'm kind of looking at now is also the yield play. So the yield play, the weaker yields that we've seen in kind of recent weeks is obviously a by factor effect of weaker dollar. yields and dollar generally move the same direction. So of course, weaker yields is a good thing because that obviously means the cost of borrowing is generally less. Now, of course, we've seen price action come back to this 3.5% level. If you look at short-term perspective, order flow is obviously still very, very much bearish as we've closed back underneath it. But I suppose the dynamic over the next few weeks is, of course, if the yield story, how does that factor into the bond markets? And of course, it would be more than ideal to see a leveling out in bond market volatility, continued weakness in dollar. And if we get that continued weakness in dollar, these yield story should continue moving lower. And of course, we talk about yield curve control, the inversion in the yield curve, which is obviously a very, very strong recessionary mandate. Even at this moment in time, yield curve is still inverted as we speak at the minute as well. All right, so that's pretty much it for the weekend markets. Everyone, I hope you've all have a lovely weekend. And of course, we will be back next week. Take care.